Michael Richardson is a GreenFaith Fellow. Some of you know that I was trained as a GreenFaith Fellow 2 years ago, and he preceded me in the opportunity. GreenFaith is an organization based in New Jersey that is international at this point. And the fellows meet regularly to talk about ways we can get involved with making a difference on our environment. The big focus of what they're doing this month is to raise awareness about divesting money from banks. And there's a whole lot of movements that you'll see in the news in this next month about that. Michael has done this workshop many times and drove here from the Hudson Valley this morning to be with us, and I look forward to what you have to share.
Thank you, Kip. Thank you. So taking from what Kip was just saying as far as GreenFaith, much of the focus that GreenFaith is doing now is on corporate divestment. We could divide it into three convenient little categories. There's the corporate divestment, and then there's the divestment that you might have from large pensions that the states might have, or a university. So again, let's look at the divestment from a state pension or a university pension, or what we might be putting pressure on to corporations to move their money away from investing in fossil fuels.
Can you define corporate divestment?
Well, think of a bank or a trust, or even a large company that has holdings. We could even look at, say, companies, as you know, often invest in other companies. So Ford Motor Company may have some investments in Exxon. So we'd be asking those corporate boards to be moving their monies away from new fossil fuel projects and into renewable energy. And I'll just use that as a segue, is it's not just to be talking about moving your money out of fossil fuel, but have that money going into investing into renewable energies. And that's what we're going to talk a lot about, the divestment and the investment. But there's also this third part about ourselves as individuals and what's happening to our money or with our money. And early on when we were having these conversations, that was often dismissed as being, oh, that doesn't make that much difference. If we all took all of our money all together compared to what we really need to do to move money out of the fossil fuel industry and transition it into renewables, the individual is not really that significant. But it is. Is you take millions of people and add it up, that if we all have 10,000, 20,000, or $500,000 times 100 million people, it makes a huge difference. Now, I use that number 100 million because roughly about half of the US population has retirement investments. Well more than half of the population has some sort of savings that are tucked away in savings accounts and banks. So it's quite a bit of money. But it does another thing as well, and I think this gets into why creation care coalitions and committees and other faith-based groups are interested in this. It's what is it as far as the psychological side? What does it mean as far as the individual transitioning from having their monies being used, shall we just say, to do harm, and having those monies used to do good? So we're going to talk about that a little bit as well. But when we talk about this workshop, as you see here in the brochure, it's align your money with your values. So the one value that we're going to have in common going into this is the value not to see our money being used to invest in new fossil fuel projects. Well, we're going to have some other values that raise their head every once in a while. For example, when we start talking about banks, I'm going to be talking about community banks. And I'll be saying, I like to buy local, eat local, and bank local. See, now I just added another value. Right? And so we might have a few more that come in like that. So let's take a look at the workshop. It's designed in such a way that you can access this at home. So the entire workshop is on one web page. And the way we went about this was that early on, trying to find the research material on banking, credit cards, home and auto insurance, and retirement investments, there is an amazing amount of material that's out there, so much that it is overwhelming. So we set about trying to find what are some good pieces of literature that we could say, take this and read all about it, and you'll come up with the vocabulary and the background material that you need so you can now figure out what you want to do. And we found that a lot of it was one article taking from another article, taking from another article, just repeating itself over and over again. You probably have experienced this whenever you've done research on the internet. And we are also finding that some of the information was a little outdated, some of it was inaccurate, and some of it was out and out wrong. And it was being repeated, or it was too simplistic, and it really didn't explain the complexity in a way that we could understand it. So what we did is we sought out to do this workshop that is 75 minutes to 90 minutes long, that gives you resources that you can tap into and shows you the processes that you might go through to align your money with your values. So the website is rivers-mountain-greenfaith.org, and it's in the brochure that I handed out. This is our home page. Rivers and Mountains GreenFaith Circle, as Kip was pointing out, is one of the GreenFaith circles. We have a footprint that goes from the Kingston, New Paltz area up to, but not into Albany, and from the eastern Catskills into the western Berkshires. So we actually go over into Massachusetts. We got our beginning as a GreenFaith circle just a year ago when we did the walk across the Mehicantuck. And this was part of the Face for Climate Justice 1 year ago. And now we're having Face for Climate Justice again this year. In fact, Kip, your event is the first event on the calendar. Today, October 2nd. So if you ever wanted to see what we did, you can go onto our website and click and see the videos. Now to scroll down, you'll see various parts of our rivers and mountains, and there's tabs that you can click on, but best just access it from the top. So up here at the top, if you wanted to read about the corporate campaigns that GreenFaith is doing, along with a lot of our sister organizations, you just click on the corporate divestment page. But we want to focus on the individual divestment. So here's the landing page. Go to the website, click on individual divestment, and you'll come to this landing page. And here is our calendar of workshops. And right down here is October 2nd. You see, last week I was at the Morristown, New Jersey GreenFaith Circle. And 2 weeks ago, I was at the First Presbyterian Church in Hudson. What we're finding is that church faith-based groups are excellent for having these workshops right after service. So go to workshop. Again, the entire workshop is on this one web page, and we've laid it out so that you're going to see personal banking, about 10 minutes on this, credit cards, about another 10 minutes, home and auto insurance, about another 10 minutes there as well. And then we'll get into the fourth one on retirement investments. So we start up here with banking because it's the most basic relationship that we have with big finance. And we simply say here, if you bank at any of these Wall Street banks, including TD Bank, that your money is being used to, quite bluntly, fund climate destruction. Now, what we mean by this is that whenever a coal company or oil company or a nuclear company wants to expand, they want to build a new refinery, they want to build a new pipeline, they want to build a new oil rig platform out in the Gulf, they need monetary capital to do this. With all the money that they have for capital investment, it's not enough to do the new project, which is very expensive. So they go to the marketplace to look for money. And of course, they can go to private equity, but private equity, they want to own a piece of it. And they can go to asset managers with mutuals and other investments. But again, that's an investment, so they want a piece of it. An investment means that I own a part of what I'm investing in. They often instead go to a bank to get a loan. Now, if a coal company came to me and said, Michael, loan me some money, I wanted to dig a new coal mine, I'd say no. I don't want to have my money go for that purpose. So they go to a bank instead, and they say yes. Now, let's go back to the relationship that we have with banks. Why do we use banks? Why do we put our money in banks?
Our money's safe.
And it's convenient. So probably the most convenient way I can stash my money would be a box in my closet, but it's not very safe for a lot of reasons. Nothing else, just if the house caught on fire, right? So we go to banks because it's convenient and it's safe. And we do it in such a way that we don't ask for much in return, much else than that. We just want to be able to get our money easily through an ATM or on a Saturday morning before 1 o'clock. And the safe part, we understand. But otherwise, we give that money to them unconditionally. They don't turn around and ask you, say, hey, I just got a phone call from Peabody Coal Company, and they want to have some money. Do you mind if I give you some of your money to them? They don't ask me that. They get the money unconditionally. So what's happening here is that the big Wall Street banks are giving a lot of that money away. Now, part of the reason is that they're getting that money almost free. Right? How much interest do you get on your checking? How much interest do you get on your saving? How much interest do you get on your money market account? How much do they charge Peabody Coal to borrow for the coal mine? It's a good gig. So what we want to talk about here is how do you find yourself where you can have, where your money is not being loaned to something that does not align to your values, but instead is being loaned to something that at least is neutral and perhaps even good.
Exxon would go to banks for loans, but they also sell a lot of bonds. You know what the ratio is between bank loans and bonds?
It fluctuates constantly depending on what project that they're going to be doing. Yeah.
No ballpark guess.
No, I don't know. As you know, usually if it's going to be a long-term project, like a refinery, there's going to be more bonds on that. And if it's something that's smaller, then we go more to the loan. And again, it's how much are they paying for the bond, the yield on the bond versus the interest rate on the loan. So when money was really, really cheap, because the feds were pumping a lot of money into the economy, they were tending to do loans. Right?
Or bonds didn't pay much either.
Yeah. Right. So with the banks, if we just use simple terms, if you don't mind, of bad and good, big banks, bad, small banks, good. There, we're done with that part of the workshop. Leave your big bank, go to a small bank.
How
Now,
small?
what is small? So all community banks and all credit unions are not using their money to invest in big industry, including the fossil fuel industry. So they're not loaning their money to Alphabet. They're not loaning their money to Tesla. They're not loaning their money to big industry. By their very nature, in some cases by their very charter, they're loaning out money in the community. So you have community bank here. Community bank is a community bank. It's actually starting to buy up some of the banks in the region. They just recently bought our little Kinderhook bank in Chatham. But community bank is a community bank. And we're going to look at them here in a moment. What other banks do you have in your community? M&T here is a relatively
Key bank.
Tompkins
Key.
is a community bank.
Yeah, Tompkins. I went to school at Cornell. I had my student loan at Tompkins Bank.
Key Bank and
Key
M&T, I
Bank.
think are the
Yeah.
big ones.
Well, now Key Bank also is a community bank. Now, based in Ohio, they have branches in Washington State. They have Washington branches throughout the Hudson Valley, but they're still a community bank. And if you did your research on them, you will not find that they're loaning any money out to the fossil fuel industry.
Really? Because they're huge.
They are very huge. And what's interesting when we get into credit cards, they also issue as well as brand their own credit card. So if you go to Key Bank and you get a credit card from them, you have a fossil-free bank, you have a fossil-free credit card. Now again, if your value is that you just want to make certain that it's not going to putting more carbon dioxide up into the atmosphere, KeyBank is cool. You might find other reasons that you don't want to be there, but they're a good bank.
That's good to know. That's something right.
So, what we do on this website, this is just the orientation on the banking. On the left hand, there it comes. All the way over here on the left hand, we've come up with a resource on Read All About It, and you can get an understanding of what big finance is doing to fund big oil and big coal. Read all about it. Green America is an organization that's been around for a few decades. They're kind of like the Consumer Reports for the environmental movement, climate movement. Fran Treplis, who heads up their banking and investment division, has helped me immensely with this presentation. Fran, along with two financial advisors, they're the people that I run things by. Do I have this right or do I have it wrong? And they guide me through it. So you can read all about it on Green America. In between here is Stop the Money Pipeline, and our GreenFaith Circle is part of the Stop the Money Pipeline Coalition. They have a little how-to as far as moving your money. I think most of us have moved banks one time or another in our lives. We got it down, right? So over here on this third one, and we're not going to spend a lot of time on this unless you want to, that there are 3 websites there that you can search about banks: Mighty Deposits, Bank Green, and Bank for Good. We're going to use the Mighty Deposits. Mighty Deposits is a not-for-profit. It's a women's cooperative, and they get their data fed in just from the non-proprietary sources, the SEC, banking regulations from various states. Their data is fed in such a way that it's always up to date, always current. So here you would go and click to find a bank or to find a credit union. So let's go and click on find a bank. Somebody want to give me a bank?
Tompkins.
That's easy. So while you're on here, you just go to look up bank. Now up here it says, I want a bank located in, you could put in a zip code or you can put in a community. That is anything. Leave it on anything, because all those other things are telling you where they're investing their money as far as small businesses, big businesses, housing. Just leave it that way. So let's just go ahead and type in Tompkins. And look at that, it comes up right away. Let me just do go. Now here, you're going to see 3 columns. We're not going to pay too much attention to the middle one because you might have a very good green bank that sits in a tri-state area. And so the percentage would not say 100%, but that doesn't matter to you all that much because it's still concentrating their money in a small locality. But we are somewhat concerned about how much money is going into the community. So here at Tompkins, the data has it that $59 out of every 100 of your dollars deposited is going to go back into the community. Now, that's an extra value, right? If you're seeing anywhere between, say, $60 and $72, that's about the normal for a real community bank. You wouldn't see much above $75 because it wouldn't be prudent. They need to have some monies held back for securities. But again, you don't want it necessarily to be like that bank in It's a Wonderful Life, that when they go ask for their money, all of it's been loaned out. Right? So you want to have some balance in between there. Now, if you want to see what's happening to those $59, you can click on See More Data. And here out of that $59, you'll see that a lot of it is going towards housing. A lot of it is going for construction. Now, only 4% of their deposits are, but that's still 107% above what would be the industry average. Now, if you were comparing this on a credit union, those numbers would be a little bit higher because a credit union is expected is a little bit more community-based than a bank would be. Anybody else have another bank?
Wilmington Trust.
Wilmington Trust. Right? So all you have to do is just go right back in and type it in. Whoop. Let's get it out
NBT.
here. Out of Wilmington, Delaware, that looks like the one right
That's
there.
it, yep.
Whoa. What
There
are
you
they
go.
doing with their money?
Oh.
And federal.
Was that them? Yeah, it's gotta be.
I want to do some research on these folks. It's so unusual to see what would be called a community bank with only 1% going
Oh,
in.
I'm sorry, that is not a community bank.
Aha. What's it investing in?
What's that?
What does it invest in?
Everything. I would say it's heavily invested in there.
Yeah. It's not pulling up a flag for fossil fuel though.
Interesting. They may be peanut buttering it across.
Yeah.
Peanut butter.
But obviously they exist for the purposes of loaning money to big guys.
Okay.
I'm glad you called that one up. I'm gonna do some research on that.
How about an online, Capital One?
Well, Capital One is a good one to pick up because they're one of the Wall Street banks. Capital One, as you all know, when we get to the credit cards, is the what's in your wallet.
Yeah.
Main bank. Now here, for some reason it didn't pull up the red flag. Might be another way. But here it's showing $38 of every 100. That's still 2% above industry average, but it's not that much of a community bank. It's loaning out to larger individuals. I wonder, we'll look at another play.
Can you do key bank? I just wanna see what the number is.
Key. Out of Cleveland. Sometimes you have to go by where their home office is. For doing purposes. So it's kind of right in the middle. It's a little bit low for community investing. And I wouldn't worry about that 27% because they're all, there's nationwide bank. But if you want to see where they're going with their investments, you just click on this again, and you can see that they do quite a bit with large business and housing. Now, my bank is the Bank of Greene County. And just a quick story on that. I banked at Kinderhook Bank in my community. The next town is Kinderhook. And they were bought up by a community bank. And I went down to see the folks. Great customer service, beautiful old restored train station, 3 blocks from my house. And I said, I'm leaving you. And I explained that since you got bought up by community bank, which is not a big operation, I'm going over to the Bank of Greene County because they're the last standing community bank. And if you went and looked at their data here, you'll see that how much money is going into the butcher, the baker, and the candlestick maker right in our community. So that's just an added value that I brought into it. Questions on banks? So if you want to, as I say, when the nights are long and the days are cold, you can go onto this website and look around by just finding a word of caution. When you're looking,
Do I understand that a credit union is basically just another word for a bank?
no. As far as the services it provides, yes, but the ownership is different. A credit union is owned by the depositors. A bank is owned by fill in the blank. Usually a bank is owned by a group of investors. It may be owned by a family. There are a few banks, the bank that I have, the Bank of Greene County, and there's only a few of these left in New York State. 48% of it is owned by the investors. The other is owned by other shareholders. There are still a few banks out there that are cooperatives. That would function much like a credit union, but they're structured differently in state law.
The credit unions are gonna, primarily, they're gonna be local, right? Isn't that?
Well,
No.
Well, sometimes they get large, like Sefco is become quite large. That's the State Employees Federal Credit Union. But you're right, Kip. By their whole charter, it used to be that you had to have an affinity of being part of a business. Or, for example, in our community, we have two credit unions. One is Greylock, that's the former Pittsfield GE Credit Union, Pittsfield, Mass, and the other one's Sunmark, that's the former Schenectady GE Credit Union. So you used to have to be in that type of an affinity. And now they've expanded it to be geographic. So it used to be if you wanted to get into SEFCO, you had to be a state employee or related to a state employee. Now it's anybody. You just have to live in the state.
The Navy Federal is global,
There you go.
and we get I don't get it. Somehow I never sees my bank account. You get a dividend every year, which is considerable.
If we went in here and were to, on the credit unions, click and start looking around for some of the featured credit unions, there's Clean Energy Credit Union out of Colorado. And they have 100% of all their loans go towards solar panels, heat pumps, and the like. That's how they're set up. So if you really wanted to see your money loaned out for the purposes of driving renewables, that'd be the place to put your money. But again, when I do my banking, I'm more interested in that butcher, baker, candlestick maker. I'm just going to quickly click on Chase before we get out of here. I don't want to spend too much more time on this.
You're in credit unions. Is that
That's why. Thank you. I was saying, why is that not kicking up? See how easy that was? I just did that so you know.
He's always alert.
So here's that flag that you see over here.
Okay.
Top funder of fossil fuels. And see $19. Why? Because their money's going into industries. And just before I get out of here, let me go back on the featured banks. Let's say that you were moving to a community and you just didn't know what to do. You could click here and say, oh, browse banks not financing fossil fuels. And these are ones that have these extra bullets over here. For example, Ponce is an Hispanic-owned bank. Carver, Black American-owned bank. Spring Bank is considered to be the green of the green banks. This is down in New York City. Sometime when you have a chance, do some research on B Corp. See the B Corp here? National Cooperative Bank is also B Corp. B Corp is a clearinghouse where you have to have very strict standards on the environment, on the governance, and other social justice issues. So it may be on the tissue paper or the soap that you buy, to clothes that you buy, or banks that you go to. B Corp has a rating system. Think of it as being the ultimate consumer reports for environmentally conscious buyers. So look up B Corp. To find a bank that has B Corp certification is rare. I think there's 6 of them in the country. So I'll just pass on that one. This bank, Berkshire Bank, which is based out of Boston, it comes over into the Hudson Valley and into the capital region. And Fran Treplitz and I are both working directly with them right now to help them get their B Corp certification.
So there's only 13?
Yeah. That met their features. Yeah.
Those are banks. Credit unions would be separate lists.
Yeah, but again, they make this list for banks. See all these bullets on the side? I mean, they're checking the box for diversity, for sustainability, for good governance. They're checking all the boxes. And even down here, Berkshire Bank, they haven't gone far enough to get a B Corp, and that's where we're helping them. Everything that Berkshire Bank is doing qualifies for a B Corp except for one thing, and that's their credit card, and they're transferring that right now. And then the rest of it is they just have to do the paperwork to file for it. You have to change some of your governance, so you have to go to your board of trustees and get some things moved around on how you identify yourself. We have a long ways to go, but We're getting there. This used to be pretty much zero, right? Okay. I'm just gonna click back out of here and we'll scroll down to number 2. Credit cards are much like banks as far as bad and good. If you have your credit card issued by a big Wall Street bank, well, they then have use of that money and they're using it as they will, again, not asking for your permission. But it's different.
Said they have use of that money. What money? They don't have my money.
Well,
I haven't paid any interest.
we're gonna talk about 2 things, actually 3. One probably doesn't count. But we're gonna talk about the nanosecond here for a moment, or flow. So, but you're a good prime on this one. We understand that with the bank, that's my money, and it stays my money until I take it out, and then it's my money stuff. It's my money all the way through. Now, with the credit card, let's talk about the purchases. Well, the purchases, as soon as I made my purchase, it's no longer my money. I have the commodity that I bought, or the service that I bought, right? So it's gone. But how it now gets used, think of this as like a chain reaction, a karmic chain, where I have done something that's going to change the causes and conditions of the very next thing that's going to happen. Otherwise, I put my money in play, and now it's going to be used.
Well, I owe money. It's not my money.
Well, no, I'm just saying that you put money in play. So like you
Yeah,
went out and
so-
bought something and you put it in play. You could have done something else. You could have paid cash, and then your money wouldn't have been in play, right? Or you
My phone
could
wants to
have,
go ahead.
or you could have bought it from another place. Because here's what's happening now. And there's 2 parts. I just want to retire the one. Hopefully, you don't have to pay an annual fee on your card. I have a card with no annual fee. A lot of them, they still have the $100 annual fee or something like that. Well, if you take 10 million people at $100 an annual fee, somebody got some real money. Let's leave that aside, and let's talk about the 3%, and let's talk about the flow. The big bucks is the flow. So at any given moment, there's a flow of money that's in play with that bank. I'm not talking about the whole system. I'm talking about if I have a credit card from Chase, they have a flow of that money. If I have a credit card with American Express, they have that flow of money. If I have a card with Community Bank, First National Bank of Omaha has control of that money. And even though it's like, if you don't mind me calling it the nanosecond, it's being paid in and paid out, but it's there, and it's there in the billions of dollars. They can use that money. That is money that they can loan out because it's always there. It's a ledger, right? Follow what I'm saying?
That's money they get from the post office, from the grocery store or the restaurant.
Well, it's just in transaction. That's why I'm talking about that's why I'm talking about the money, the nanosecond. There's that nanosecond of me buying and then paying. Now, actually, it's probably more like 45
2,
minutes
right?
or something like that, whatever. But there's always money coming in, there's always money going out. But that crescendo that's up there, that is the flow. And they can use the flow. They can loan on it, they can invest on it, because it's actually on the ledger, it's real.
So you're saying when you make when I make a purchase, that now there's flow on.
You
the
put
credit
money
card
into the
company.
system.
Well, the credit
Not
card
yet.
company system. That's what you're talking about.
The
Yes.
restaurant
Yes.
now owes,
Well, it owes the restaurant.
yeah,
So you put money in play, and then it gets paid back out. So you think like, well, who can make money on my money if it's like going like this,
Mhm.
other than that little percentage that they hold back for the service that they've just performed. But the thing that we're saying here is that there's billions of dollars that are sitting there that they get to use, and it's free. So they can turn around and look. So there's one, we're going to talk about premiums here a bit if you want to talk about free money. Banks are almost free. This also is free, and it's there. So how do you make it so that Chase, Citi, Wells Fargo, and the others that are turning around saying, well, I know what to do with this money. I mean, some of it's going to go off to Alphabet, some of it's going to go off to Tesla, Some of it's gonna go off to Exxon, some of it's gonna go off to Kebler. They're gonna move that, what's going on. How do I stop that? Well, you need to go to a bank that's not doing it. But it's not necessarily your community bank. It is in the case, who's got Key? Right, Key, you're cool. They're not doing it.
So you have to get their credit card.
Well, let's talk about branding and
Yeah.
issuing credit cards. Yes, hand back there.
Yeah, I guess it's just a brand. He's a MasterCard, is what you're talking about.
MasterCard and Visa, that's not, no, we're not talking about, MasterCard and Visa is a system that the banks own. So all the banks own Visa and MasterCard, and it's just there for the process of sharing money back and forth. It's the mechanism that's doing that. And they pay Visa a fee for doing that. They pay MasterCard a fee for doing that. You can actually invest in Visa and MasterCard if you want.
Venmo isn't really a bank, right? But do they still use our money in the
No.
same way that banks do?
No,
So we don't have to worry about it?
nope. PayPal too, don't have to worry about.
Okay, thank you.
Because the money immediately transfers.
So let's talk just a minute.
So
Yeah.
Michael, just quickly, I'm not sure I quite get that yet. So
Yeah.
let's say that I buy something from you and I've got a credit card service with Chuck. So I've just bought $100 of stuff from you. I'm asking Chuck to pay you. How does that create more money for him to invest?
In the nanosecond, he's got that on his ledger.
But it's a liability.
Doesn't matter, it's still, he's got it on his ledger
It
to
doesn't
use.
matter, it's a liability. It's
No,
not
but
an asset.
Well, he does, he's holding it and transferring it. But
It's not like the paper.
in that nanosecond, the flow is there, and it's the flow that they have in play.
Because I haven't sent anything to Chuck yet. I haven't sent $1 yet. I've created an obligation that he has to fulfill for $100 to you. I haven't sent a penny to Chuck yet. He doesn't have my penny.
Yeah, he does. He's the bank that issued the card. He has your penny.
Where'd you get it?
Visa or MasterCard.
Yeah, this sounds very mystical.
Makes
I
sense.
asked
He
Chuck
knows
to
how.
pay my bill. So I've created an obligation with you. I've asked Chuck to pay it because I'm gonna pay him back. How does he have any more in his hand to invest at that moment than he had before?
On his ledger.
Yeah,
Ledger,
on
what the-
I have
paper.
a,
It's a liability.
there's no, there's no
We're
cash in the check.
we're gonna get in the weeds here and not get through the workship if we go too far into
Yeah,
this.
well, this
This
doesn't
isn't
make
weeds.
sense.
This doesn't make any sense.
Well, at the end of the workshop, let's just spend some time on it. Because really, if we spend 5 minutes on this, we're gonna miss.
I mean, Cindy,
Things
can
on
you
investment.
explain where that penny, that extra penny
We're
goes?
moving on.
The other thing that we're gonna touch on here a bit is the service fee that goes along with this. But let's first get to understand what credit cards are doing. All right, if I have a Chase card or a Citi card that is branded by Chase, so it says Chase on it, or it says Citi, or it says Wells Fargo, it's being branded by them. It's got their picture and everything. It's also being issued by them. This is where I want to stress, there's the branding and there's the issuing. It's the issuing that we're concerned about, the issuing bank. Now, what happens there is there are credit cards. Got a real quick sleep time. Here is the Evergreen card that is branded by First National Bank of Omaha, and it's issued by First National Bank of Omaha. Right below it, you'll see the Climate card that is branded by Beneficial State Bank out on the West Coast, and it's issued by Beneficial State Bank. Both of those banks are brick and mortar banks. Now down below, you'll see this Amalgamated Bank. Amalgamated Bank is an old bank down in New York City that was founded by labor unions. They're considered to be a very progressive bank. They brand a credit card, but they don't issue it. It's issued by First National Bank of Omaha. Community Bank brands a card. It's issued by First National Bank of Omaha. First National Bank of Omaha is not investing in fossil fuels. So that's what we call the fossil-free bank or the fossil-free credit card. That's why when you see up here, we like here's First National Bank of Omaha, Beneficial State Bank. I want to talk for a moment about TCM. TCM is not a brick and mortar bank. It's a bank that exists for the sole purpose of issuing credit cards for other banks, not-for-profits, and institutions. So if you pull out your credit card and you take a look at it, I happen to have an amalgamated card. And the reason is my bank of Greene County that I love so much, they're not in the credit card business. They decided they didn't want to brand it. They didn't want to issue it. They just say, Michael, you got to go someplace else. So I went over to amalgamated. This is a 1.5% cashback card, and it's issued by, fine print, First National Bank of Omaha. If you had your key card here, it would say key on it, and you turn it over and you say, it doesn't say anything. It doesn't say city. It doesn't say First National Bank of Omaha. I can't even find TCM. If it says nothing, they're issuing their own card. Same thing for a credit union. If it says nothing, they're issuing their own card. Now, credit unions, they have their own TCM. It's called CUNA. So CUNA, again, not a brick and mortar bank. It exists for the sole purposes of issuing credit cards for credit unions. So in a simple world, if you want to get away from a credit card that's being issued by a fossil funding bank, dirty bank, let's call it. If you want to get away from that, it's not as simple as changing from big bank to small bank. You need to go find yourself a credit card that's being issued by a fossil-free bank, whether it be TCM, First National Bank of Omaha, Beneficial State Bank, or by the bank itself. Now, also, you can go and get these things called affinity cards over here. And I put up the Green America card. If you read below there, the Green America card is issued by TCM. In that same paragraph, we mentioned the Sierra Club card, and that's issued by Beneficial State Bank. Now, what happens here is that you're familiar with the 3%, that when you buy something, there's a 3% charge that goes to the vendor. So sometimes when we go to a small shop, we pay cash because we don't want to take their marginal profit away from them. But when we go to a big store, we don't care. Oh, I kind of left this out in the beginning when I talked about, like, why do we use banks? Why do we use credit cards?
Carry cash.
Points.
Oh,
I mean, you could use a debit card. You know, if you want to be fossil-free, go get a fossil-free bank and get a debit card, right? Now you're not even in the credit card game. It's just like writing a check, except for it's electronic. It's points. So I get on mine, I get that 1.5% cash back. I could do rewards too, but I'll take the cash and go buy what I want to buy. So when you're doing this for for Green America, that 3%, now sometimes it's 5%, sometimes it's 2%, but let's just use 3% as the general theme here. Green America will get 0.5%. So that's a way of me donating to Green America. Or Sierra Club will get 0.5%. That's my way of donating to Sierra Club. Well, most people will tell you, don't do that. Go get a cash back card, take whatever money they have there and write a check to Sierra Club, write a check to Green America. That's probably a smarter way to do it. So anyhow, they get 0.5%, the brander. So let's go to Amalgamated Bank that I have. They get 0.5%. I get 1.5%. Who gets the remaining percent? First National Bank of Omaha. So this is where more money comes into the banks. Now you could say that, okay, if they're giving 0.5% to the brander, and they're giving anywhere from 1% to 2% to the consumer, and they're keeping back around a percentage point, that's not big bucks. But think of all the money that's going through credit cards. That's big bucks. 1% of a little is a little, 1% of a lot is a lot. Just, I want to move on to auto insurance, but a couple of things. There's also what we call down here at the bottom, store cards. So we talked about the branding and issuing of credit cards. Another form of credit card is your affinity card. That's where the brand is some organization that you want to support. You want to be careful here because you have like working assets. Remember them from back in the 80s, 90s? They were cool, right? Well, their card's issued by Bank of America. And so read the fine print. World Wildlife Foundation, Bank of America. Go figure.
Wow.
So anyhow, the other card is the store card. Verizon, Lowe's, like that. Amazon has a couple of store cards. They also have a city card. And their city card is like if you buy certain things, 5% credit on it. But you want to look in the same way that you look for the TCM or the other logo. Down here we have Committee and Synchrony.
Oh, wow.
And those are also banks. They're not brick and mortar banks that exist for the sole purpose of issuing credit cards that are store cards. And so if you have your Verizon card and you turn it over, you'll see Community. If you see your Sam's Club and you turn it over, you'll see Synchrony. And those are also fossil free. So again, on Amazon, if you have their city card, you're still in the game. If you have their other store card, you're out of the game. And then we'll come back and talk about flow a little bit later. So next one. Moving on. Home and auto insurance. Now, who would have thought, right? I always thought that I was getting my home and auto insurance from a home and auto insurance company, right? Little did I know that I'm getting it from a fossil fuel insurance company. So to explain that, first of all, when we buy a premium, that's no longer is our money, right? So we talked about banks and we talked about credit cards and all that kind of stuff. Like, as soon as I buy the premium, if I don't have an accident, I don't get that back. It's gone. I bought my premium. Now, I used to think that my premium went into this risk pool along with yours. And then when you had an accident, his claim got paid, right? It does work that way. But just like the bank is not keeping it in the vault, they're not keeping it in this risk pool. And there's a lot of it there. Now, think about how good this is. Everybody may not have a bank account. Everybody may not have a credit card. But almost everybody in some way, shape, or form has insurance. Even if you're a renter, part of your rent is paying your landlord's cost of running the place, which includes the insurance. So we have laws out there, and they're good laws, that say I have to have auto insurance. When I go get a mortgage, my bank says, and you've got to have home insurance. And when I want to have a protest rally in Albany, the city of Albany says, I've got to have insurance there too. And this is all for the insurance company, free money. What are they going to do with it?
Invest it.
Why not? Because there's money to be made. Yeah, let me get this right. I get it for you for nothing, and I loan it to him for 10%.
Good deal.
Good deal, yeah. I mean, that's a better deal than the banks. They at least got to pay me a fraction of a percentage point, right?
But you
So-
do have to be able to cover for, if you're in Florida and you're insuring houses and so forth. I
Oh,
mean,
these days,
you have to have some reserve and you have to be able to ante up.
Yep.
If there's.
Yeah,
But-
insurance companies have left.
yeah,
the
we're going to
state.
talk a little bit about reinsurance right at the end. But anyhow, what's happening with your money and why?
They don't want it.
To explain this. First of all, I can go to my bank and say, I don't want you loaning my money to these things that don't align with my values. But now it's no longer my money. It's their money. And to be real, they're in the insurance business. And what do insurance businesses do? They insure things. And so they insure factories, they insure pipelines, they insure shopping malls, they insure oil rigs. They go out and they insure. Now, quickly, think about big energy, big oil. When something goes bad, it goes bad in a big way. So BP oil platform, Exxon Valdez, Peru pipeline. When it goes bad in a really big way. And the way this works is high risk, high premiums, and if your actuaries are any good, high profits. So they have access not only from the premiums that the oil rig platform is going to pay into it, they also have all those premiums that we have on our home and auto. So there's massive amounts of money that they have out there to go out and play the risk game. And they do it very, very well. So if I want to get away from that, and again, when I went to my bank, I wanted my bank to not do bad things with my money. In fact, I really don't even want them to do neutral things with my money. I want them to go out and do good things. The butcher, the baker, the candlestick maker in my community, the farmer. My credit union, it's a little bit more of a fudgy game there because, first of all, we're not talking about big bucks. I mean, I use about $2,000 a month that goes through my credit card. So it's like $24,000, and if only a fraction of that's going off to do bad, it's not a huge thing, it's more symbolic, right? Even when I talk about my insurance premium on my house and my home is not big bucks. I mean, it's a fat check, but it's not really big bucks. But I still want to make certain that it's not going off in a way that I don't want it to. So what's the alternative? The alternative is not necessarily to go to, I can't just walk into another shop and say, can I open up an account? You usually have to go through an independent insurance agent. Right? You can't call up the Lizard in 15 minutes or less. You have to go talk to somebody. And we're very fortunate in most states, New York being in particular, where we have many of these community-based insurance companies, mutuals, cooperatives. Any of you have your insurance with Utica Mutual? NYCM, New York Central Mutual? Sterling, Progressive? Too bad because like they all started right down here in Cooperstown area. All of them, all four of those came from there.
Progressive was in Cleveland, I thought. Is there another one?
I meant to say preferred, but I said Cleveland. I'm sorry, thanks. So on our website here, at the top, you see the big commercials. Allstate, Chubb, Erie, Hartford. Liberty Mutual is the largest as far as investing and insuring fossil fuel. In fact, on investment alone, leave off the insurance side, on investment alone, they invest so much that if they were a bank, they would rank number 4 in investments in fossil fuels.
Liberty Mutual has $156 billion to invest, according to this report. That's a lot of money.
That's a lot of money. And so now, one thing that's happening here is, try not to go off on a tangent. Liberty Mutual, for an example, is investing a lot in fossil fuel industry. And they're also insuring a lot of fossil fuel. Now go figure that. They're actually insuring what they own a part of. Now you want to make money, come up with that type of a setup, right, where you're insuring part of your own investments and making money off of your own money. So explain back. So a lot of us,
it goes well or goes bad, right?
yeah. Well, that's where you have to have a big enough pool, and you have to make certain that Inu is selling plenty of car insurance every night, because they need that cash flow coming into the pool, right? Because you're fairly low risk, right? And you're just putting that money into the pool as a fairly low risk source of money for them. But many of us go and say, stop doing what you're doing. So if I want to go to Liberty Mutual, I'm a little bit ahead of myself. Definition of mutual is the same as the definition of a credit union. The people who pay the premium own the company. So Utica Mutual, I own a piece of it. NYCM, my partner Joanne, owns a piece of it. It's a mutual. But the dirtiest of all is Liberty Mutual. Now go figure. When their trustees get together, when their board of directors get together, all those votes come in, and all those votes get to vote. Well, if they're the number one insurer of fossil fuels got a lot of votes at that table, right? So I want you guys to pass a resolution that you're going to stop doing this and you're going to transition over to this in the next 7 years. No. So it's like talking to your shirt to go petition Liberty Mutual to get clean. And they are not listening. Kip, we're getting ready to do this demonstration against TD Bank for the tar sands. Liberty Mutual insures the tar sands. Chubb got out, AIG got out, Zurich got out, Liberty Mutual went in. So how do you get there? You go to an independent insurance agent and you say, I want out. So I had traveler's insurance, and I went down to my insurance broker, and I was a little rough on the edge, saying, Kurt, you've had me in Travelers for 10 years. I want out. So he quoted me. Came back, exact same coverage, apples for apples, $700 a year less. I said, Kurt, let's not adjust for inflation. That's $7,000 that I paid to Travelers. I should have been paying to Utica. My partner Joanne, she has our house and her car bundled. She is with Allstate. She saved $500, apples to apples. And just, I don't need to tell you this, you know it already. When you go shopping for your insurance, make certain that the broker is going to shop apples for apples. Here's my policy. I want you to quote that policy. Oh, no, I want you to quote that policy, because that way you'll know where you're up and down. Now, your next question is, am I underinsured or overinsured? And we found, when I get feedback from this workshop, which is quite a bit, nobody has said that it costs them more. Now, there's one couple that they found they were underinsured, and they found they were able to get up to where they wanted to be for literally a percentage point more than what they were paying before. So they were very happy. But it's worth going out there and shopping around. But when you do, you want to make certain, of course, that you're with an established company. These companies that I mentioned up here, this on our website, Utica, Preferred, Sterling, and NYCM, that's New York Central Mutual, they've been around 100 plus years. And they are very conservative. If you have young people in your house, they may not take you. If you have a vacation home that you don't spend at least 90 days in, they won't take you. But again, Liberty Mutual might not take you either. Mm-hmm. But they're a very conservative company. But you know that your premium is going to go to investing and insuring the local dairy, the local factory, the local butcher, baker, candlestick maker. Now, Utica Mutual used to have their headquarters in Utica. They still process their claims here, but they have a big 7-story building in Hartford now, Connecticut. Sterling is still around the area. NYCM is still around the area. And these are companies I would recommend that you go see your insurance broker and talk to them about. Now, also, you can change banks anytime, right?
Right.
And you probably go through about a 1-month process of doing that because you want to make certain everything clears. So I go open up a new account. I move almost all my money around. I wait a couple of months, make certain everything clears, then I move the rest of it up. Credit cards, I stop making purchases on it. I go making purchases on my new card. I wait 2 months because I forgot those 2 companies I had automatic withdrawals on. They show up on my statement. I close it out. So 2 months to change your credit card, 2 months to change your bank, 2 minutes to change your insurance. And you don't have to wait for renewal. Now, when I left Travelers for Utica, I was 5 weeks away from renewal, so I waited. Joanne, she said, I'm not going to live 6 months in sin. I'm getting out. And so state law, they have to rebate you 100% to the day. So when you go in there and say, it's over, I want a new guy, you get a new guy. Now, they didn't do that for your consumer privileges. It's just people move. They come and go. And so they had to have arrangements by state law that you can cancel and you get your rebate today. No penalties.
Can you do this without having to go through a broker or somebody can just tell it?
I'm going to say in New York State, no,
Okay.
because the alternatives are not going to be that attractive. You're going to do better with these guys.
That's their job.
If you're down in the Southwest or in California, there's a wonderful company, Amica, that you can do online. Also, American Family, you can do online.
So if I want to change my car insurance and a renter's insurance and all that, I couldn't just call Utica Mutual?
No, you're going to have to call a local insurance broker.
Okay, thank you.
Michael, is there any advantage to, so I've got a broker I've used for years, but there are other brokers that have approached us and said, hey, we'd like to, is there any advantage to playing 2 brokers off each other? You're going to get the same quotes?
Yeah. Now, one might not write Utica
Okay.
and the other would.
So
And
look at who they represent.
So actually, I went to 2 brokers, and the one that didn't change my plan,
Yeah.
I'm not with him any longer.
Right.
We're still friends. And I told him why I was leaving, that I was angry with him, and I was leaving because I was angry with him, but I'm still your friend. The other person, we have he's, let's just say, much more aggressive about this. I've made some phone calls around various areas, particularly in the Hudson Valley. And I get these two responses from the brokers when I tell them about what we're doing. Oh, really? Yeah, I've heard a little bit about that. And, we are concerned. And, those are great companies. They are New York State companies. And this is really great. Tell me more. And if anybody goes to your workshop, you just have them come right in and say they went to one.
Yeah.
And then the other one I get is, well, okay, that's what you want. So my new broker is enthusiastic. But they get their broker fee back from the insurance companies. Right now, they're not this evil. You like to think they are. I could have said, Kurt, I know why you write with Travelers, because 4% more on more is more, right? So he's going to get his broker's fee and it's by the cost of the premium. So of course I'm going to sell you a higher premium, but that's not.
So two brokers, if one does 90% of their business with Utica Mutual, and the other one does just peanuts with Utica Mutual, they'll still get the same quote.
Yeah, but probably the peanuts guy got dropped.
But I guess what I'm trying to say is, I guess I'm asking the same question. Can a broker deliver better with the same company?
No, state law keeps it fixed, because otherwise you get rigging. So state law says you get X% on your premium.
Got it, thanks.
It's the broker fee, it's called.
Yeah.
Same thing happens with medical insurance. Question?
No, I was just curious, what would benefit the brokers to get me more stuff, but you just answered it. They get a fee based on my.
Yeah, so let's say my annual premiums are $4,000, 4% of that versus $3,000, 4% of that.
Right. Am I naive to think that my broker is looking for the best price for me?
You are naive, because the excuse I got from my broker when I said what's going on here for 10 years is like, well, we can't. I'd have to have all sorts of people working here doing it. Like, we only look at it if you. And of course, my attitude was goodbye.
Yeah. Okay.
So I'm still a little confused. If you go to your broker and you ask them to look at all 4 of these?
Well, you could say, I went to a workshop and these were mentioned. What do you think of these? And I want quotes on them. And
On apples to apples to my current policy.
yeah. But maybe they have some other things. Now, I got into a little bit of an argument with my new broker because he wanted to quote me Cincinnati, and I said, don't bother. Well, why? And I told him. And he said, well, no. I said, I don't want to do business with Cincinnati. First of all, they're not a New York State based one. They're based in Cincinnati. And even though they're not heavy into fossil fuel, they're heavy into other things that I'm just not into. So I said no. So sometimes you might get a broker that wants you to push something. The only 4 that I recommend in New York State are those 4. There are others that are okay. But I just, shop around. I think you'll get good quotes from these. Now, you're not as clean as you thought you were, though, because even though they're small, they do have to be careful about big claims. Now, we don't have the earthquake, we don't have the forest fires, we don't have floods, but they all have reinsurance. And the reinsurance is usually through Allianz, Zurich, Chubb, Lloyd's, and they're investing in fossil fuel. So the word stop loss, is that something like that? It's so they're actually insuring their inability to cover their claims. And so they pay a premium to another insurance company, a bigger insurance company, saying, listen, if I get wiped out, I got all these claims I got to pay. And so that's insured. So it's reinsurance, or they're insuring the risk that they've taken on your behalf.
Lloyd's of London is the famous name.
Yeah. And Allianz.
If your cargo ship sinks, probably the insurance company can't pay it.
And just in closing on this, on altruism, you can go find yourself an altruistic bank. You can actually go find yourself an altruistic credit card. These insurance companies, it's not necessarily that they're sharing your values and just be a little bit flippant. They're just too small to be dirty. So all 4 of those companies could put their monies together, and they probably don't have enough to insure an oil rig. It's too small to be dirty.
Could you just repeat the 4?
Utica Mutual, NYCM, which is New York Central Mutual,
Right.
Preferred, and Sterling.
Not
Sterling Cooperative.
Allstate. I thought you said
The Allstate is, Allstate originated, I believe, back with the days of Sears, and then they got sold out, but no, they're major investors in fossil fuel and insurers of fossil fuel.
Good. Thank you.
Allstate would be one that would not align with your values. That's, my partner Joanne had Allstate, she left them
She
for
left them, okay.
NYCM.
So Michael, Chubb
We
is
both
probably
heard
the
that.
scale.
Yeah, and again, Chubb is under a lot of criticism right now because Chubb, along with a couple other companies, are saying what good they're doing. They've walked away from all new coal, pretty much. Or at least they have this margin that the company can't have more than 20% of their assets off in coal. So they've really reduced their insuring of coal. They've walked completely away from tar sands. AIG, same, has walked away from tar sands. But if you look at the rest of their portfolio, they've actually increased.
Okay.
So they walk around saying, look at what we've done. And we say, look at what you're doing. You know, you've upped it on the other side. We're about ready to incorporate our circle, so I have to go get my own insurance for these events. And the guy quoted me Chubb, and I said, that's not gonna work. Okay, I probably have taken more time than I should have on this. I get phone calls and emails literally from around the country when I do these workshops on Zoom. Well, what do you think about Amica? What do you think about? And usually what I do is we spend about 15 minutes online doing our own research. So I kind of show you how to, the first thing you want to do is who owns, let's pick on Amica again. Who owns Amica? And you find out they're a mutual. Okay. And then you want to know who they're insuring because you want to have a Liberty Mutual type situation, right? Where the bad guys are controlling the way the company does its business. So you just start doing your research on them. And then, of course, the big one that you're concerned about is how secure are they? How solid are they? So these four that I've listed up here are very reliable, very conservative companies. You don't want to get a fly-by-night, right? So if you want to read more about this, the Rainforest Action Network has a good read all about it. And this Insure Our Future, this logo over here, they're the source of all sources when it comes to big insurance, big oil. Read all about it. Retirement investments. It's much like with the banks again. It's your money. And you're hoping to get security out of it. And you have certain expectations. But unlike the bank, when you give your money to the bank, it's unconditional. When you invest, you have a contract. So you're either buying a stock, or you're going in and you're getting a mutual fund, or you're getting a bond, or you're buying into a portfolio, and you are writing a contract. I am giving you my money, and here's what you are going to do with it. But we rarely read the fine print. If I said, where is your portfolio invested? You might not be able to tell me. I don't know. They put me in the Vanguard mutual fund. Well, who are you funding? I mean, like you own a piece. I mean, you own these businesses. Like, what businesses do you own? I don't know.
Doesn't everybody read the annual reports from each of the mutual funds?
So let's talk about exchange traded funds, the ETFs, the mutuals out there. First of all, 80% of all the money that's being invested in ETFs and mutuals is going through passively traded funds, passive index. Does that ring a bell with anybody? Heard that word? Now, what that means is that the person who's put together the index is charging a very, very modest fee to take your money and do the same thing that the index is doing. Now, I use a very simple way of explaining it, so I don't mean to insult anybody by how simple this is. But imagine that I'm a consumer, and I'm a big-time consumer, and I like things nice and dependable and reliable. But I have absolutely no time. And so the Joneses over there, they are always getting the smartest things. I don't know where he finds his time to do all that research, but he gets the best of the best with the best warranties and the best everything's fine. So I go and find myself a person, let's call that person an asset manager. And I say to him, I'm going to give you my money, and you're going to stock my house. And so when Mr. Jones goes out and gets an electric Volkswagen that's white, and it better be white because there's a reason that Mr. Jones got white. And then on and on. He gets a 57-inch whatever Sony, not a Samsung, I want Sony. So you go out and you buy exactly what Mr. Jones buys. And if he decides to have a yard sale and get rid of it, you have a yard sale and you get rid of the same thing. So you just do what the Joneses do, because the Joneses do it right all the time. Or they do it more right than anybody else. The Joneses is your index. I'm the consumer, and the asset manager is the asset manager. So here's how your mutual funds work. You go in to see usually a financial advisor. This is another guy. And I go see a financial advisor and say, I got some money I want to invest. And so he sits down and he puts all this stuff together. He says, well, I'm going to put you off with this asset manager. And now that asset manager is going to go out and get an index. Oh, and I tell my financial advisor, cheap. I don't want to spend a lot of money on this. Don't worry about it. There's this thing called Vanguard. And Vanguard's gone out and they've replicated the Standard & Poor's 500, which is the entire market. It's the breadth of the market. So industries come in, industries go out slowly. Commodities rise, they fall, oil, but the market is just being the market. The asset manager has no say on what's in that market. It is what it is. And so I come in and I sign a contract saying, here's my $100,000. I'm going into this IRA, and I want that IRA to index the Vanguard portfolio. They've got to do it. That's what they do. And they charge like 2% on the penny.
Who charges 2%?
I said 2%, 0.2%.
200%.
Yeah, for a Vanguard.
For a Vanguard.
Another zero right now.
Yeah, something.
And the reason is because it's 100. Now, there was human power that set up the initial computer, but that's it. It runs and it runs and it runs. And so you have huge pension funds that just use the Vanguard index. And they've been famous at doing this. Other companies have come around and replicated that. Now, just a quick aside on who owns who. The big ones are BlackRock, Vanguard, State Street, Capital Group. BlackRock, Vanguard owns 40% of BlackRock. All of BlackRock's ETFs are managed by State Street. So they're just a nice little club. Mm-hmm. So many of us have gone around saying, don't do it that way for me. I still want to play mutuals because I want to be diversified. So you know how a mutual works. You got about 5.4% in this. You have about 2.2% in that. Never have more than like any 6 or 7% in anything. It's all spread out. Usually about 20 or 30 different funds are in there. And so you say, I don't want to have this one, I don't want to have that one, I don't want to have that one, and I want to put this one in there. Now you're moving away from the passive managed index into an actively managed index. Now it's still quasi, because they can go build you a fund. You hear a lot about the ESG funds now, and we find out that some of the ESGs aren't quite as E as we want them to be. They may be S and G, but they're not as E as we want them to be. So there's other indexes out there, and they're getting bigger and bigger as the demand is growing and growing on them. But still, 80% of it is offered here in this passively traded indexes. But the thing of it is, the more managed your portfolio gets, the more expensive it is because it takes human power to manage it. So what do? It's much more like the insurance that you need to go find yourself a financial advisor that's going to be sensitive to what you're saying to them, that I don't want to be in these funds. And of course, you want to have a good financial advisor that keeps you from being stupid, right? Mm-hmm. And so that person might be pushing you. You want to make certain that the performance is up there in that 8, 9, 10% on the long haul. Nothing looks that way in the short run. Here we go. This left-hand column one, this is a frequently asked question, FAQ. So if there's that one place that you could go read and get your vocabulary up and understand what's going on, it's that site right there. This middle one, I don't know if we're gonna have time to play with it, but down here on this button on finding assets, that's how you can go find asset managers. And there are some mutual funds out there, Pax, Parnassus, Trillium, Green Century, that are good funds to go through. They're tried and true. That's where I recommend people go. But what we usually spend almost a half hour on, Kip, is this tool here, as you sow. And it has in here, are your savings invested in fossil fuels? Now, the first thing I would take people through is to go up here to the menu and go to the tutorials. And most of us ignore tutorials. At least go do an introduction. Ignore the rest of them, but if you do an introduction, that will really save you a lot of time groping around in the dark. So back to where we were, you would go to this web page, menu, tutorials. Now you can also, there's other buttons on that menu that will look at deforestation, prisons, weapons, and the like. This page is for fossil fuels. And you could just type in a fund. So if we typed in a fund like Jackson National. Now Jackson National is an asset manager. It's small. It's not like a Vanguard or a BlackRock. It's a big company, but it's Jackson National. And yeah, there are many, many funds. This Get More Funds button you'll become very familiar with. You just keep on hitting it, and it just keeps on adding your funds. So this website, quickly, what it does is, first of all, it has the name of the fund. It has a grade of A, B, C, D, F, based on its greenness, let's call it. Hence, A is green. Red is F. It talks about sustainability mandates. You can read all about that, carbon footprints, whatnot. This Clean 200 is an important index to look at because that's going to tell you the companies that they're investing in that are not fossil fuel. Otherwise, you want to take your money away from fossil fuel and into clean energy. Now, most of these funds that even get B and C rating, only 4 or 5% is going into fossil fuels, where 20% might be going into green. So if you're looking at a B graded fund, it's not necessarily one to ignore. You just want to be aware of what you're doing because it might be just minuscule here where it's doing a whole lot of good over here. C's and D's you stay away from. F's, of course, you stay away from. But just to show you the power of this tool here, this first one, whenever you see this, the JNL with a slash and another company, so that could say, have another asset manager with a slash. The first name is your asset manager. The slash is the index. So this first one you see here, J&L is using a T. Rowe Price index. So they just buy the index from them. They pay them a certain amount of money. That's why I say that somebody's out there establishing an index, program a computer. Otherwise, instead of the Joneses, this is the Smiths. Now, on this website, we're very concerned about what's going on with performance. So you see, just click one over, performance. And you'll see here that here's a really nice fund. It's a J&L Mellon Information Tech Fund A. I actually have this fund. Tech sector, real estate, healthcare, by their very nature, are going to be fossil free. But your financial advisor will also warn you against putting more than 10 or 20% of your money into a tech sector. So I actually have 10% of my portfolio in that fund that we're looking at right here. And why not like it? On 20 years, 13%. 15 years, 12. Here's 17. Here's 18. Even on 3 years, it's 18. Now, always be careful about the 3 years because everybody's done good over 3 years. And whoops, it's down 18%. Don't I know it? But hey, unless you're fossil fuel, everybody's down. So my financial advisor is going to say, Michael, I really want to see how it's doing on 10, 15, and 20. This is a solid performer for a long time. Now, I'm also concerned, okay, I kind of like this one. But let's go see what it's doing as far as Okay, here it is right here. So I come over and look at this. 41% of it is in the Clean 200. So I click on the Clean 200, and here it is. J&L Mellon, no fossil fuels. That looks good. So I come down here, I look around a little bit, and I want to see what's going on with this Clean 200. So I come up here, click, and hey, Michael, it's got 21% of it's an Apple. Cisco, Adobe, see all. Now, some of us might have some issues when we see things like Apple, or here's Hewlett Packard, but this website tells you where your money is going. So when I said earlier, okay, you got these funds out there, you can literally go to your portfolio, and on every one of those left-hand columns, you're going to see a ticker number. And type in the ticker number, and you can see exactly where the fossil fuel investments are. I'll show you one, and also where the greens are. Now, all this data, again, is non-proprietary. It's fed in by SEC and other regulatory agencies. So if you went to your Morgan Stanley guy, he's got this data. It's just on a different program. If you go to my bank, my financial advisor, he uses this. And Berkshire Bank now is using this. So it's a good user platform. It's designed for environmentalists, obviously, because it's A ratings. If you looked at the Morgan Stanley, they don't have it graded A, B, C, D, F. But they have all the same data. It's just how they're processing it. So again, nothing's proprietary here.
You said this particular fund is 21% in Apple?
Yeah.
That would set off bells, because, you know, if Apple has a bad quarter, the whole thing changes.
I'll tell my broker that.
Yeah.
And you heard me say earlier that you rarely see anything more than 7% this in one company. This is really heavy on Apple.
I would put it at 2%, but that's.
Yeah. So let's just back out here and look at a dirty fund. And why not? Let's pick on Vanguard. So here I'm not doing tickers. I'm putting in asset managers.
I'm afraid to.
Now you see this number right here, it's probably too blurry, but right below everybody's name is their ticker number. And that's what you would see on your statement that you just type in. But here you can toggle like this. So here's some F's.
Wow.
I don't want to pick on a 99% one. Can you imagine that 99% of their investments are in fossil fuels? Let's pick on something down here that's in the 20% range. So they're 19.5%. Here's the companies that they're investing in. Now here's how rich this website is. Here's 66 holdings that are in carbon reserves, 74 holdings that are in coal, fossil fuel fired utilities, 112 holdings at $264 million. So let's just click on that and see, it actually lists my companies. And see all. Now, some of these, like Sumitomo, never heard of them. Do a web search on them. You'll find out exactly. So this is how deep you can go to find out exactly what's happening with your investments. Now here we're looking at the fossil fuel holdings. They must have had a little bit of green. Let's go see. Yeah. Okay. They got quite a bit of green, 270 million in it. And you can see that some of these I might not be real happy about. Unilever.
This is a very narrowly targeted fund, right?
By dividend, it's high dividends. So you
Yeah,
can
high
buy
dividend.
energy.
Yeah.
But and then your fossil or the renewables would probably be more growth companies. So
Yeah,
they would be paying
yeah,
dividends, so that
yeah.
would be-
Now again, for our corporate campaigns that we do, it also has this thing. This is something that this website just added recently on banks and insurers. You can click there and see who is insuring some of their fund. So when the days are short, the nights are long, and it's cold.
I'll say.
You're really bored.
I've spent hours on this website, not in summer, not in summertime.
This is so much more user-friendly than say Morningstar. Morningstar is very awkward, and you can't get to the
You
individual.
don't get to the end.
Yeah.
And again, this is it's a group, it's a group of financial advisors that got together and pooled their resources. They got their funding from a variety of sources. Tides put in some money. Some of the banks and investors put in some money to come up with a user-friendly pool like this.
Are you done?
That wraps it up.